if you are managing your money and your investments emotionally, you're probably going to make the wrong one. It's about time in the market, not time in the market, which means as a human being, you have to be correct 100% of the time. And I can guarantee you, as a human being, you will not be correct 100% of the time. I don't know if you're going to make money in the markets this year. The market doesn't know that you own it. I don't know if you're going to make money in real estate the next 2 or 3 years. I don't know. But I do know long-term in good quality assets, you can do really well, because by the time they get to 50 and 55, and I see it all the time, they say, I wish I had have started sooner. I'm Lloyd James Ross, 7-figure investor and entrepreneur, and I've helped thousands of business owners and professionals turn financial stress into success. If you're stuck in old money habits, overwhelmed by investing, or unsure where to start, this is for you. I'll give you the mindset and strategies to take control, grow your wealth, and achieve financial freedom. It's time to make your money work for you. Here are the top 10 investing mistakes in under 15 minutes. You're probably making 1 or 5 or all 10 of these mistakes right now. And trust me, they're costing you years of compounding growth and financial peace. So in the next 10 minutes, I'm going to break down each of the 10 worst investing mistakes you can make and how to actually avoid them and never do them again. All right. So they're fast, they're brutal, no fluff. Let's go. Number 1, chasing hot stocks. Now, this happens as soon as a stock goes up drastically in price, people want to know about it. This happened with GameStop, if you remember. The GameStop stock jumped. Everyone started talking about it. And of course, the actual underlying business that it represented was crap, and they should never have touched it, but they only wanted it because everyone else wanted it. And this is what happens if you chase hot stocks. The same thing happened with NVIDIA, and now NVIDIA's come right back because China's starting to replicate its chips, and it's starting to get hit from a business standpoint. So chasing hot stocks is not the way to get ahead, because by the time you've discovered them, it's usually at the very top of the market, all right? So chasing hot stocks is not a good strategy. You want to buy stocks in businesses you understand and that will stand the test of time, not just a hype. The second of the 10 investing mistakes is timing the market. This happened recently with gold. As soon as gold went up from $2,500 an ounce to $3,500 an ounce in 6 months, everyone was starting to talk about gold, which means everyone now wants to own gold. That's called trying to time the market. You're bouncing in and out of the market. So to buy gold just because it's up means you're trying to get it on an upswing. And generally speaking, if you do it there, you're going to find that the next day or two, it's going to come backwards. And this also happens when there's the trade war that's currently happening at the moment between the USA and China. People are trying to time the bottom, and they're trying to then get out. And so they're trying to buy at the bottom, buy low, and they're trying to then sell high. And they're trying to play this game of buy low, sell high. They're trying to dance in and out of the market. And the reason why that doesn't work in anything, in crypto, in gold, in stocks, in index funds, is because you have to make 2 decisions. One, you have to decide when to sell. And the second decision is you have to decide when to buy back in, which means as a human being, you have to be correct 100% of the time. And I can guarantee you, as a human being, you will not be correct 100% of the time. Even as an AI bot, you will not be correct 100% of the time. Because even if robots could time the market like that, they'd already be doing it and all the assets in the world would flow to them. But they can't, because no one can. So it's about time in the market, not timing the market. So buy it, hold it for a long period of time, and your odds of making money go up drastically. The third investing mistake that people make that I don't want you to make is not understanding what they own. So people will buy an index fund, or they'll buy stocks, or they'll buy crypto. They don't even know what they own. And so of course, when the market gyrates and gets volatile and starts moving around, especially when it collapses, they freak out because they actually don't know what they own. They think a stock represents a blip on a screen, on a chart. It doesn't. It represents legal ownership of a business, of a company, which means if you know about the business, you know what you own, which means you're not susceptible to diving out of it or being scared out of your stocks or scared out of your investments because of what you don't realize you own, okay? So recently, for me, we owned some Chinese equities, and when the stock market collapsed by about 20% after the tariffs came out, 10, 20%, people say, why, Lloyd, you're going to buy it? You're going to own that stock? I'm like, yeah, I own the business. Like, oh my God, it just fell. Like, so what? The business is going up in value. Why would I care what the price does, right? So understanding what you own will prevent you from being scared out of what you have, all right? The fourth greatest investing mistake people make is over diversifying. This seems ridiculous, I know, because diversification is mitigation of risk. I understand that, but most people over diversify. What does that look like? It means they've got one or two properties, they've got index funds, multiple. They've got like 5 or 6 or 7 index funds. They own collectively like 4,000 businesses. They own a little bit of gold. They own a little bit of crypto. They own a little bit of art. They own a bit of Lego. They've even got this NFT here. They own everything. They own so much, there's no more risk in it, which means there's no return. So yes, you'll get smoother returns, but I would much prefer a lumpy 15% a year than a smooth 4% a year. So when you over diversify, you actually diversify your returns, okay? So to avoid diversification, you will be fairly diversified with 3 assets, either a piece of real estate, an index fund, and perhaps something else or a business. But I own 3 stocks, and within those stocks, there are some wonderful businesses, and I'm fully diversified, and I'm very happy there. So be careful you don't over diversify. The 5th greatest investing mistakes people make is they under diversify. This is ridiculously contrary to what I just said, but they'll put everything into fart coin. Like some person, can you believe this? They took $1 million and they put it into the Huck Tour Girl coin. The Huck Tour Girl. Huck Tour. Spit on that thing. That's what they put it into with a meme coin. That's what they did. And they lost it because she rug pulled everyone. That's under diversification. It's ridiculous. This is what people do. They also only invest in one piece of property. That's also under diversification. They'll invest in one stock from one business. For example, if you had have held stocks, just one stock in Virgin Airline here in Australia, after the COVID, you'd have no money left. So be careful you don't put all of your money into one stock or one business. It's nice to have 2 or 3. 3 is good. Perhaps a house and 2 or 3 other assets is fine. That's diversification. It does mitigate risk, and I definitely wouldn't suggest full porting into one asset class. There is a saying from Andrew Carnegie that says, put all your eggs in one basket, but watch the basket. I agree with that, but most people don't have the capacity, the financial IQ, or the patience, or the ability to do that. So I would say, just put it in a couple of baskets, okay? Just quickly, if you're ready to take control of your finances but feel stuck on where to start, I have a solution. My book, Money Buys Happiness, simplifies investing and wealth building with practical steps to help you achieve financial peace. Get your copy via the link in the show notes, and let's get your money working for you. Now back to the episode. The 6th most common investing mistake people make is ignoring fees. This happens a lot to people's superannuation and 401ks. They don't realize that their particular fund manager is charging them 1% or 2% annual management fee to do nothing, to actually underperform the index. And so fees do add up over time. And this is why I'm a big proponent of investing in low-cost index funds over real estate. Because if you look at real estate investments, for example, if you buy a property investment, you got to pay so it's $1 million investment. You got to pay about $60,000 or $70,000 in stamp duty. That's a fee. Then you've got to pay body corporate fees to manage the apartment. That's a fee. It takes away your cash return. Then you got to pay a property manager to look after it. Then you got to pay maintenance costs, fees. And by the end of it, you've got, after inflation, negative return, cash return on your property investment under the current market conditions. So you've got to be very careful of these fees. They're always hidden in things. And if you compound fees over long periods of time, that 1%, 2% can translate to millions of dollars lost on your capital. All right. Number 7, greatest investing mistake people make is reacting emotionally. And this is what happens when you don't understand what you own. If you're trying to time the market, if you get caught up in all the noise from the news's job is to stoke fear in you. And that's what it's great at doing. It's what sells news. But when you start to buy into the fear mongering, and they call it FUD, fear, uncertainty, and doubt. And if you buy into the FUD, then you can create sort of these emotions in yourself. And if you are managing your money and your investments emotionally, you're probably going to make the wrong one. So try and be logical, follow the signal, not the noise, and reacting emotionally to things, sleep on it before you make decisions. That's one way to overcome these emotional decisions that people make that usually end up with them shooting themselves in the foot, okay? Number 8 of the worst financial or investing mistakes you can make, following financial influencers without vetting them. Okay, so for example, if you're on TikTok or you're on Instagram, whatever it is you're on, there are people out there promoting shitcoin. And obviously the Huck Tour girl is a great example of that. For a moment, she was an influencer and she was getting everyone to buy her meme coin, and then she rug pulled everyone and they lost money. The same thing happened to Trump when he did his Trump coin. But you got to vet the influencers. So like what portfolio do they have? What do they invest in? What is their skin in? They got to have skin in their own game. But not just that, do you want the life they have? And if the answer is no, don't follow them for those things. Vet people, not just influencers, but vet anyone that you're taking any lessons from. Just understand, like, do I want to have that part of their life that they're talking about? And if the answer is no, don't listen to them. But vetting them is important. And you tend to vet them by watching how they are long term, off camera, on camera. Do you share the same values? Okay, so making sure you're vetting them, not just following blindly. I don't know how many people had this one person before I was verified on Instagram. I used to have so many scam accounts built of me. And so one lady, she said, Lloyd, I've just paid the money. I'm like, what? What for? She goes, the crypto thing you said. I'm like, what? No, what? She goes, yeah, you DM'd me. And all these like messages there, like, I'm like, oh my God, and you gave them money? She goes, yeah. I said, how much? She goes, $250. I'm like, what? Why? So she didn't vet. I mean, you only have to follow me for 5 minutes to know how much I hate Bitcoin and crypto. And she still did it. So just be very careful. Look at the verified badge, follow them for a while, get to know them. Do your values align? Okay, vet them. Don't just follow them blindly. Number 9 of the worst investing mistakes you can make is to think short term. I had this lady reach out to me recently. She goes, Lloyd, I'd like to learn investing, but I want to do it faster. Like, join the club. I want to get a higher return, but do it quicker. I'm like, join the club. Everyone wants to do that, but that's not, just because you want it that way doesn't mean it's going to be like that. Warren Buffett's got this great saying. He said, and Warren Buffett's the greatest investor who's ever lived. He said, you can't have a baby faster by getting 9 women pregnant. Great things just take time. And if you do speed up the pregnancy process and you have a baby at 6 months or 7 months, the baby can die. So just because you want it in a shorter time frame doesn't mean that it's good for you or good for your situation, all right? So you can't have a baby faster by getting 9 women pregnant. So just slow it down and understand that wealth takes time. I don't know if you're going to make money in the markets this year. The market doesn't know that you own it. I don't know if you're going to make money in real estate in the next 2 or 3 years. I don't know. I don't know if you're going to make, I don't know. But I do know long-term in good quality assets like certain real estate and like certain index funds and shares, I know long-term you can do really well. But over the next year, no one knows what the market's going to do. No one could possibly have known that Trump was going to pull out Liberation Day and start tariffing China 145. No one could see that. So I don't know what's going to happen in the next 12 months. No idea. But thinking short-term is a massive error because the odds grow that you're going to make money in the market the longer you have it in there. And I read this article the other day. It said the odds of making money in the market over a 20-year period are 100%. 100% statistically. All right. Number 10, the last one, the last investing mistake people make is never starting because they get so scared of losing money. They don't even do anything with their money. And of course, their money doesn't grow beyond inflation and the value of their money falls over time. And before they know it, they're broke at 65 with no assets, no idea. And they're like, oh my God, I can never retire. And if that's how you want to be, then just don't start. But if you want to change that, you just got to start. Start with something. Put the money in and then take it out the next day. Just start somewhere. Start small. People are trying to start so big. Just start small. We've got a multi-million-dollar share portfolio. I started with $2,000. I bought shares in a bank. That was it. I started. And once you start, you then learn more and you learn more and you learn more. We started our network marketing business with $500 and we got one sale. Just start small. Think big, but start in baby steps. Start small. Every great big thing was started with one small little step. So not starting is the greatest risk you can take, and it's probably the biggest investing mistake people make because by the time they get to 50 and 55, and I see it all the time, they say, I wish I had have started sooner. So if that's not you, you don't want to be that, then I hope you take these lessons on board and grab our book, Money Buys Happiness, if you want to learn more about getting yourself financially under control and moving forward. And of course, if you've enjoyed the episode, hit the subscribe button, leave us a question or a comment below on YouTube, or hit the share button, hit the 5 stars. There's a lot of things to do there, isn't it? But do those things for us. Appreciate it. Send this to someone you love, and this will help them on their journey. And go take action. I'll see you in the next episode of the Money Grows on Trees podcast. Thanks for listening to Money Grows on Trees. If you enjoyed the episode, leave a 5-star review on Apple Podcasts and Spotify, and subscribe to us on YouTube so you never miss an episode. And if you're serious about building wealth, make sure to check out the links in the show notes and follow me on all social media platforms at Lloyd James Ross for more. See you in the next episode.